So on balance sheet, you had cash flow. This will come in from cash flow statement. This will just be stats. Account receivable done. Total inventory done. Deferred income tax. This is current tax. Okay. So deferred income tax again. So what we do is that when we forecasted the income statement taxes, we took the effective tax rate and we stretched it. So our assumption is that whatever tax becomes due, that will be paid in future. So if I am paying whatever comes due, then my deferred tax asset will also remain stable. So this again can be stretched as stable. Prepaid expenses and other current assets. Prepaid expenses and other current assets. So again, prepaid for forecasting prepaid expenses, I know that expense relates to sale generally. So what I have done is, and what are the expenses generally? These are SG&A expenses generally, selling, general and administrative expenses. So what I have done is that I have taken prepaid and other current prepaid expenses and other current assets, and I have taken SG&A, and then I have calculated prepaid expenses as a percentage of SG&A. Why? Because my assumption is that expense would relate to the total expense of the company. It will be certain percentage of the total expense. So I have it for 15 and 16. I took the average and stretched it over. So this is how I can forecast a prepaid expense percentage. And if I have prepaid expense percentage, I can forecast prepaid expense by multiplying that percentage with SG and A. Any confusion so far? Any problem? Okay. So moving on, balance sheet again, prepaid expenses can be forecasted at a percentage of SG and A. Otherwise, if there is anything else, then for every item you need to revise a strategy of your own. So if there had been some specific prepaid expense related to some specific expense, then we would have taken some other route. Current assets held for sale, again we can start it as it is, assuming no change. So if yes,
basically what you have done is for every line item forecasted in the income statement, you are linking it with the balance sheet line items
if needed. So certain items of balance sheet like accounts payable, account receivable forecast is linked to revenue. So you calculate debtor days and then based on forecast of income statement you forecast this.
Is linked to
yes. Inventory is linked to COGS, payable is linked to purchases.
And
prepaid expenses were linked to SG&A because I know this is an expense. So for my expenses, I will pay some expenses in advance and I will delay some expenses. If I am paying some expenses in advance, then then my assumption is that there will be certain percentage of total expenses which I will be paying in advance. So I took the last 2 years percentages, took its average, and based on that percentage, I multiplied with the forecasted SG&A and I forecasted.
So therefore, disposal of a business, if it is coming in income statement, it can be used to forecast the goodwill in balance sheet. Is that?
It will, but we are expecting no disposal, no acquisition.
So that if
you are expecting a disposal, then that will come in your revenue forecast. That will also come in your asset forecast because then your assets will be reduced because you have sold off that business. And yes, that what was the question next? So goodwill, yes, it will. No, goodwill disposal will not come in goodwill. Acquisition will come in. Yes, so if there is an acquisition expected, then it will come in goodwill forecast as well. But you need to know if you really are acquiring or not. Secondly, if you make the acquisition, then that acquisition's value will get added to your business. Currently, your business is separate. So we are valuing current business. So if there is any acquisition or disposable impact, if you are sure about it, something happening, then you incorporate it. Otherwise, you eliminate it and you take the company as no disposal, no acquisition forecast.
Some companies have other comprehensive income in the income statement.
Other comprehensive income will not be used for your forecast. Because why? Because your OCI is not a part of your earnings is not a part of your P&L earnings. Your P&L ends at net income, and then after that these items are those items that impact equity but not impact P&L. So they will go into, so for example, if there are any significant, what are the OCI items? So in OCI you have exchange gain and losses. Exchange gain and losses wouldn't impact your cash flow, right? Because they are unrealized exchange gain and losses. Realized ones would be in P&L and would have been forecasted. Unrealized wouldn't impact your cash flow. If it doesn't impact your cash flow, it wouldn't impact your FCFF. If it doesn't impact your FCFF, then it wouldn't impact your value. Then you will have actuarial gains and losses. Right? What are those? Those are the losses or gains due to changes in assumption of pension fund. So for example, if assumptions changed and now assumptions are of higher life expectancy or lower life expectancy, there will be certain unrealized gain or losses. Again, those are unrealized. They wouldn't impact your cash flow. As they do not impact your cash flow, they wouldn't impact your valuation. Anything which impacts value, there are two things which impact value. One is your discount rate and other is cash flow expectation. If there is anything happening which have no impact on cash flow expectation, that wouldn't impact your value. If there is anything in there tangible in any company's OCI which you think will become a part of cash flow, for example, if there is a reserve which you think will materialize, or if there is a litigation or liability that which you think will have to be paid off, then you will account for it in the cash flows, and then through cash flows it will flow into your valuation. Otherwise, OCI changes will impact your balance sheet equity, but will not impact cash flow. And so we assume it to be stable because we know it wouldn't impact the final value. So current assets held for sale, some business or some asset that you have held for sale, stat it as it is. Property, plant and equipment, we will do it in next class because then we will need to make a fixed asset schedule. Goodwill. So if you are planning an acquisition, if you think there will be an acquisition, if you are very sure about it, and if you are also sure about the price that will be paid and the goodwill amount, then you can add it. Otherwise, just keep it as it is. Not zero. Just in assets, you do not turn any asset or liability to zero. Just keep it as constant. Constant means no change. So stable means no change. If you change it to increase it or decrease it, then an impact will need to be taken in income statement or cash flow statement. So if you think it wouldn't impact your balance sheet or income or cash flow statement, you keep it as stable. Trademarks and other tangibles. Again, no acquisitions, no disposals. So straight. Non-current assets held for sale already been sold in 15. There are no non-current assets as of now. So stat it as 0. Other non-current assets, again, nothing tangible which we are expecting to impact our income or cash flow. So take it as it is and stat. So in balance sheet, most of the items would be consistent. So that's why balance sheet forecast is easier. But there will be some items which will need specific attention, which are account receivable, account payable, inventory. Cash would come in from cash flow and fixed asset schedule.